Trump did a good job of distancing himself from the ticker because would really be working against him right now. 30 to 50% would not be highly unusual. Doesn't maybe every 10 years or so it actually does that. But let's see what happens. But we're probably going, at best case, we're going into a recession. The stock market's going to go down more. Unemployment's going to go up.
Jim Rickards, investment advisor, lawyer, economist, editor of The Strategic Intelligence, which is a financial newsletter, author of multiple best-selling books. I know your newest book is out, Money GPT. So folks, go ahead and pick up a copy of that. Jim, it is great to see you as always. Great to welcome you back on the show. We always love having you on. So really appreciate you taking the time today.
Thanks, Julia. It's great to be with you.
Well, thrilled to have you. And for folks watching and listening, we are recording on Monday, March 31st. It is approximately 10 a.m. Eastern. This is the big week, Jim. Liberation Day coming up on April 2nd. Will we see those reciprocal tariffs? What will those look like? That's also my birthday. A lot happening this week. I'm looking at markets today. They are selling off. So let's kind of step back. Maybe since we had you on right after the election. Now we're 2 months into the presidency. Can we just start big picture? Then we can get into tariffs and some other topics. But let's start with that big picture, more of that macro view, where we are today.
Sure. And by the way, you're right about this week, Julia. Happy birthday, by the way. Tuesday we have some, without getting too down to the weeds, Tuesday we have some important elections in Wisconsin and Florida. Mm-hmm. Wednesday is Tariff Day, phase 1. Thursday is Tariff Day, phase 2, and then Friday is the March employment report. So there are sort of big landmines out there every day this week, and the markets are nervous enough as it is. So you're absolutely right about the situation. So big picture, what's going on? I don't think I invented this phrase, but I'm calling it MAGAnomics, and then I think others have come up with the same phrase. But kind of what's under that umbrella, if you will, and none of it is overly complicated, but it has a lot of moving parts, and you really have to sort of go kind of step by step to see how it's all playing out. Just digress quickly with regard to the tariffs. One of the reasons the markets are so nervous, I always say that markets can deal with good news and they can deal with bad news. They can't deal with uncertainty. When they don't know what the news is, people just kind of sell and go to cash and look for liquidity and safe harbors and all that. And the problem with Trump, it's an advantage and a disadvantage at the same time. He likes to, he's the art of the deal. He's highly transactional. He likes to keep people off balance. There's something to be said for all that. I think Napoleon and Richard Nixon did the same thing. But as I said, it's very, very confusing for markets. So is he actually going to do all the tariffs on Wednesday and Thursday that he said? He might. I'm not saying he's bluffing at all. But I am saying that there are back channel discussions going on, and we could wake up a Wednesday morning and he said, well, I'm putting these tariffs on China and Canada just the way I said, but we got to deal with Mexico. I'm not forecasting that. I'm just saying that that's the kind of uncertainty that we're dealing with. The auto parts thing, auto manufacturing, assembled autos, seems real. I think they're going to go through with that. And, obviously designed to promote the auto industry in the U.S. I mean, Trump's basic message when it comes to tariffs is, to foreign companies, whether it's China, BYD, the big auto companies based in Canada, Mexico, Europe, with everything. Volkswagen has not done a good job of getting their plants in the United States. They're a little bit behind the curve there. But whoever it is, he's saying, look, you can sell all the products to Americans that you want, but you have to build it here. Put your plants in South Carolina or Tennessee or Mississippi, Michigan, as the case may be. But the point of tariffs, it will collect money. Tens or hundreds of billions of dollars. But the real point is jump the tariff wall by putting your plants in the United States. And there have been a lot of announcements along those lines, as I'm sure you and your audience know. Honda, Hyundai, Taiwan Semiconductor, Apple, which is a U.S. company, but puts most of its investments abroad. They're all putting stakes in the ground in $50 or $100 billion plants in the U.S. So that's all going on. But the real problem is, will Wednesday and Thursday play out the way we expect? We'll find out Wednesday and Thursday, but that's the problem. We don't. There's one thing to say, here's what we're definitely doing, and here's the date. but Trump says, here's what we're going to do. Here's the date, but I might change my mind. That's very, very hard for markets to digest. But the best assumption is, the tariffs are going on. That explains why the stock market's going on. I talked to someone I know very well, who's an Audi dealer in the United States, kind of like in a high-end zip code. And he has been in the business over 30 years. And he said they have never been busier. People are actually selling cars like crazy. People are lined up in the showroom. But that's because of the tariffs. In other words, Audi is a foreign manufacturer. They're going to get hit possibly with 25% tariffs beginning on Wednesday. So if you like an Audi, buy it now out of inventory off the lot before the price goes up 25%. So that's good for his business in the meantime. But the problem is everything's going to fall off a cliff on Friday. We got basically you're taking 6 months of demand, moving it forward to beat the tariffs, and that's good in the short run if you're in any of those sales areas. But you're just going to hit a wall on Thursday, and it's going to take. You can't build an auto plant overnight. It takes two years, possibly longer, and so it's going to take a while to adjust to that. So a lot of disruption going on. But getting back to the big picture, what I call MAGAnomics, there are three principles, three individuals, and think of it as a three-legged stool. So I'll just go through the three legs of the stool very, very quickly. The first one is called the 3 Arrows Plan, also known as the 3-3-3 Plan. And this was proposed by Scott Bessent, Treasury Secretary. And, we can do calculus if you want, but it's really fifth grade math. He basically says he wants deficits below 3% of GDP. And that's where Doge comes in and, cutting all the expenditures. But there's a lot more to it than that. I mean, Doge is doing a lot of good work, but if it's wasteful, cut it out by all means. But those numbers, even 100 million here, $1 billion there, it takes a long time for that to add up to $1 trillion. So they're going to need to do more radical surgery than that. But basically, get deficits below 3% of GDP. The second leg of the stool, the second three, if you will, is get real growth at 3% or higher. But the key thing there is real growth. We'll come back to that in terms of inflation. And then the third leg of the stool is 3 million new barrels of oil per day. Added production, 3 million barrels of oil a day. So 3-3-3, deficits below 3% of GDP, 3% real growth, and 3 million barrels of oil. What does that do? People say, well, we got 34, actually more at this point, probably $35 trillion of national debt, which is true. We can't pay off the national debt. What are we going to do? So you don't have to pay off the national debt. We haven't done that since 1836 under Andrew Jackson. You don't have to pay off the national debt. You do have to roll it over. When outstanding Treasury securities, bills, notes, and bonds come due, you've got to basically issue new ones to pay off the old ones and keep it going. We've been doing that for 230 years. So what's the key to that? The key is sustainability and confidence. If you lose, it becomes not sustainable when the world market loses confidence in your ability to somehow keep it under control. What's the best measure of that? What's the best way to think about whether national debt really is out of control? The answer is it's a very simple ratio, debt to GDP. What's the national debt and what's the GDP? Now, you have to think of both of those in nominal space. I always bang the table about real versus nominal, but here, when it comes to debt, it's nominal. If I owe you $1, I owe you $1. Whether it's worth $1.10 or 98 cents based on inflation, interesting, but I owe you $1. Right now, that ratio is over 125%. I mean, it changes every day. We're paying so much interest. But it's over 125%, the highest in U.S. history. The last time it was close to that high was immediately after World War II. 1945 was about 120%, but I say at least we won the war. We were a global hegemonic economic power. We got something to it. And by the way, from 1945 to 1980, that dropped from 120% to 30%. 30% totally sustainable, totally comfortable. It's like a small balance on your credit card. You have no problem paying it up. Since 1980, it's gone from 30% to 125%. So who's at that lunch table? Well, it's Lebanon, Greece, people you don't really want to be with. So the national debt is not going to go down. It's going to keep going up. But the key is the ratio going down? And that's where the 3 arrows come in. if the deficit's going up less than 3% of GDP, and if GDP itself is going up 3% real, but you have to add inflation, because remember I said that ratio is in nominal space. So if you have 3% real growth and 2% inflation, let's say, you have 5% nominal growth. So now if you're living in a world where the debt is going up less than 3% of GDP and growth is going up, nominal growth is going up more than 3% of GDP, what's happening to the ratio? It's going down. I guess it was fifth grade math when I went to school. I'm not sure what they teach now, but basically, if your denominator is growing faster than the numerator, the ratio is going down. It's that simple. And if you see that ratio going from 125% to 120%, 115%, and so forth, it's still high. It's still really high. But if it's moving in the right direction, that will inspire confidence and basically help keep interest rates low and help the basically maintain the reserve currency status of the dollar and help the U.S. Treasury market. So, and the oil thing is a little bit of an add-on, but what does 3 million barrels of oil per day additional production do? It lowers the price of oil. And what does that do? I said months ago, I was talking to Peter Navarro, I said, and he's a brilliant economist, but I said, if you want to end the war in Ukraine, get oil down to $40 a barrel, because that's Putin's pain point. We have not been able to put any pressure on Putin. The sanctions are a joke. I mean, they're not a joke. They actually boomerang on us. They hurt us. Right now, the Russian ruble is stronger than it was before the war in Ukraine started. The Russian economy is booming. The biggest problem is they have a labor shortage because everybody's working. They put it on a war footing. They're producing more, shells, tanks, cruise missiles, hypersonic missiles, et cetera, than NATO combined. So the Russian economy is doing fine. The sanctions have had no impact. But you take oil down to $30, $40 a barrel, that cuts their revenues in half. And now you put pressure on Putin. So that's how the kind of geopolitics of oil play out. I'm not sure that's the intent, but that will be the effect. So 333. But what it doesn't wipe out the debt. It doesn't make it go away, but it makes it sustainable by lowering the ratio and improving confidence. So that's Scott Bessent. Then we got our friend Peter Navarro. He's Mr. Tariffs. He's the trade and manufacturing czar, and we all know about tariffs. We kind of talked about those at the beginning. What do tariffs do? Well, there's the mainstream capital E economic profession view, and then there's what actually happens. It's usually the economists have no idea how the economy actually works. But so what would a mainstream economist say? So, like contributor to Project Syndicate or somebody from MIT or Harvard or wherever. They say tariffs are inflationary. And the Democrats sort of ran this theme in the 2024 election. Tariffs are a sales tax on the American people. Whatever the price is, you throw a 10 or 20% tariff on top of it. It's like a sales tax on the American people. And there was some intuitive appeal there, and that actually got some traction. They lost the election, but that idea stuck around. The idea is completely wrong, and here's why. So how do tariffs actually work? So you're a Chinese manufacturer. You make products. You've got a cost structure. You sell it to an American importer or distributor, and then they distribute it and they sell it to the consumer. You could have 5 parties, but they're the big 3, the producer, the importer, and the consumer. Who actually pays the tariff? Well, the importer writes the check. The port of entry, Port of LA, Port of Houston, you got to write the check to the Treasury Department for the amount of the tariffs. But who bears the cost economically? How does that cost get spread? The one place it does not go is to the consumer. Because if you're a distributor, Walmart, Target, anybody, if you could raise prices, you would just do it. Who cares about tariffs? You would just raise prices if you could. Everybody would. But they can't. The consumer's tapped out. Credit card lines are used up. Auto loan delinquencies are rising. Unemployment's going up. It's not a nightmare, but it's going up. Real wages are stagnant. Mortgage interest rates continue to remain high. There's just a whole long list of reasons why the consumer is tapped out. They can't raise prices. So who bears it? Well, they either push it back up the supply chain to the producer, say, hey, sorry, producer, you have to lower your prices to me so that when we add the tariff, my net price is the same. or the importer might bear part of it, or the importer and the producer, the exporter and the importer, in other words, might share it. But either way, their gross revenues go down, their margins go down, but the one person who does not pay it is the consumer. So it's not inflationary. In fact, it could actually be deflationary if you're forcing producers to lower their costs, et cetera. So that's kind of how it works in practice. So it's not a sales tax. It's not inflationary. It does not hurt the consumer. It could reduce profits and gross revenues and margins at the exporter-importer level, but that's their problem. And so, but what does it do for the United States? What does it do for workers in the United States? Well, going back to what I said earlier, Trump said, well, you can sell to Americans with no tariffs. You just have to build it here. So now we're creating high-paying jobs in the United States in semiconductor manufacturing, automobile manufacturing, steel, other kinds of manufacturing. We're restoring the hollowed-out U.S. industrial economy, and they're not exclusively union jobs. A lot of them are, but those are high-paying jobs. So now you're giving real wages a boost, real incomes a boost. That helps consumption. That gets into a virtuous circle of promoting growth. So tariffs are a good thing. By the way, we don't have time to do the whole history, but from 1790 to 1962, this is how America grew. This was called the American system, started by Alexander Hamilton, carried on by Henry Clay, John Quincy Adams, Abraham Lincoln, William McKinley, and Dwight Eisenhower, and many other presidents in between. And now these things feed into each other, right? Because there are tariffs. I'm not saying tariffs. I'm not saying no one has to write a check. I'm just saying it's not the consumer. But when the importer and the exporter write the check, it goes to the Treasury. That's revenue. That helps the deficit going back to the 3 hours. So these things all sort of connect at some level. And then the third leg of the stool is the Mar-a-Lago Accord. Mm-hmm. And this is, by the way, I did coin that term. You go back to 2019, my book, Aftermath, Chapter 6. The title of the chapter is The Mar-a-Lago Accord. So my readers were 6 years ahead of the curve on this one. I mean, today everybody's talking about it, and this guy, I'll get his name wrong, Zoltan Pozsar.
Zoltan Pozsar, yeah.
Zoltan Pozsar. He was at Credit Suisse, and he has his own, kind of research firm now. And Steve, but the big advocate is Stephen Miran, Miran. So who's Stephen Miran? Well, he was at a hedge fund, and he's an investment advisor, think tank guy, really smart guy, good analyst. But he's now the chairman of the Council of Economic Advisors. So he's in the White House. And he came out with a paper last November, just before, kind of right around the election time. I'm not sure if it was just before or just after, but it's, I hate to do this to people, but it's 26 pages, single space, very densely argued, very technical. But I really urge everyone to read it, everyone who's interested in this. This is the Mar-a-Lago blueprint is in that Stephen Miran paper. It's not hard to find. He was at, I think it was like Hudson Bay Capital or Hudson something. But
I know. Yeah, there was definitely, I want to say Hudson. Yeah, one of those.
Yeah, Hudson something. You'll find it. It's easy to find online. Read that paper. So what does he say? He says, put the tariffs on. So he's with Peter Navarro and Trump on that. So we need tariffs. But he makes a very interesting point, and it's a good one. You can manipulate the foreign exchange markets to offset the impact of the tariffs. I said earlier that the producer, the exporter, bears some or all of the tariff. Okay. But what if I'm China and I cheapen my currency? I devalue my currency. In other words, the United States puts a 25% tariff on China, but China devalues its currency by 20, 25% and lowers its cost in terms of US dollars. In other words, the US dollar strengthens against the Chinese currency, which means US consumers get more for their money. So the exporting country who has to bear the cost of the tariff can offset the cost by cheapening the currency. That's just, again, very simple math. And now we're back to currency wars. I hate to sound like a book salesman, but my 2011 book, Currency Wars, goes through this in a lot of detail. Okay, so Miran gets that. And he says, we don't want that. We don't want China and Europe and but Germany really and India and the rest of the world fighting our tariffs by cheapening their currencies. we want to actually cheapen the U.S. dollar. We want a cheaper U.S. dollar. The effort to devalue the U.S. dollar is the offset to foreign countries devaluing their currencies. So where are we now? We're kind of back to the Plaza Accord. And that's why I called it, and that's why everyone today calls it the Mar-a-Lago Accord. Trump likes ornate architecture. So, I mean, the Plaza Accord is at the Plaza Hotel, which Trump used to own, by the way. That was a Trump property at one time.
Yep.
But it's I like the Plaza. I go to the Palm Court for high tea sometimes, but it's very ornate. Well, what's more ornate than Mar-a-Lago? I mean, practically nothing. So they'll have it there. But this goes back to the Plaza Accord. Now, what Miran wants to do, he wants to have his cake and eat it. He wants to cheapen the dollar, weaken the dollar, but not lose reserve currency status. And that's, hey, if you cheapen the dollar, not think is it still the reserve currency? Well, he wants both. Has that ever been done? The answer is yes. It's been done twice. Once by Richard Nixon in 1971, and once by James Baker in 1985 at the Plaza Accord. Now, Nixon, of course, went off the gold standard. So the price of gold went up from $35 an ounce to $800 an ounce between August 71 and January 1980. That's a 2,700% increase. Another way to think of it is if you think of the dollar by weight of gold, that was a 95% devaluation of the dollar. But we did not lose our reserve currency status because of the Petrodollar Accord in 1974. And I had a role in that. It was my first meeting on official business in the White House. I met with Helmut Sonnenfeld, who was the deputy national security advisor. He was known as Kissinger's Kissinger. He was, Kissinger was the national security advisor. Helmut was the deputy, but everyone thought Helmut was smarter than Henry. So he was sort of the big brain. We were working on the invasion of Saudi Arabia. It was Jerry Parsky and Bill Simon, who was Secretary of the Treasury.
Jerry Parsky's been on this show.
Oh, well, he's great.
Yeah, he's wonderful. He's probably like episode 3. Yeah.
Yeah. It was a good cop, bad cop routine. So Parsky and Simon were the good cops. They went to Saudi Arabia and said, if you price oil in dollars, everybody in the world is going to need dollars because they need oil, but you can take the dollars and put them at Citibank. And the Citibank will lend to South America. They'll buy our stuff and the whole system will keep going. And it worked. But that was the carrot. The stick was invading Saudi Arabia, setting up a security perimeter around the oil fields, setting the price, pumping the oil, putting in trust for the future Arab people, basically taking over Saudi Arabia's oil fields. So that was the team I was working on. And we leaked it to the Chicago Tribune. And anyway, that's the whole story. But it worked. Basically, Parsky did that deal along with Bill Simon. But my point is, Nixon devalues the dollar 95% measured in gold, and also against the other currencies. That was the Smithsonian Accord, a Smithsonian Agreement, they called it. But we got about a 20% devaluation against the yen, but everything went down against gold. But we preserved our reserve currency status by the petrodollar deal. Okay, so Nixon pulled it off, and Ford followed up. James Baker did the same thing in 1985. 1985 was the all-time high for the dollar, using the Fed's broad trade-weighted all-currency index. There are a zillion currency indices. That's the one I use. And the Fed maintains it. But that was the all-time high. And everyone agreed that the dollar was too strong. So Baker convened, it was France, Germany, Italy, Canada, and Japan. I might get one of the countries wrong, but 5 or 6 countries, including Switzerland, at the Plaza Hotel. And they agreed jointly to cheapen the dollar over some period of time. But they did it by manipulating the foreign exchange markets. Those central banks and finance ministries intervened in the foreign exchange markets to cheapen the dollar, and it worked. And then the Louvre Accord in 1987 was when they said, okay, done. Now we got to where we wanted to go, so now we're going to stabilize it. And you had a long period from 1987 to 2010 of currency peace. It wasn't a currency war. That was pretty good stability and good growth all during the Clinton years. Okay, so Nixon did it. Baker did it. Here comes Stephen Miran. And I haven't met him, by the way, just to be clear, but he seems really smart. His paper is really good. But I'm reminded of Lloyd Benson's comment, I knew Jack Kennedy and you're no Jack Kennedy. I mean, is Stephen Miran James Baker? That's the question. Maybe not. And he doesn't have, see, what Baker had was the ability, the U.S. is very, much more dominant at the time. Is who are the big powers today? Well, it's China, Russia, and India, more so than Europe. And we're in a proxy war with Russia. We've declared China, number one threat. India relations are pretty good, but they're part of the BRICS. So are you going to get the same kind of cooperation from the major trading partners that James Baker did in 1985? I think that's doubtful. And Miran seems to know that. So he is coming up with what, he didn't use this term, but I will. I call it the traffic light system. But he said, we're going to take all our trading partners and call them green, yellow, and red, like a traffic light. Green means you're with us, you're willing to cheapen the dollar, and you're going to get two things. You're going to get better tariff treatment, and we'll extend the nuclear umbrella, if not by treaty, just informally. We're going to protect you. You're on our team. Yellow is like, you're kind of neutral. You're not an enemy, but you're not helping us, and you're going to get reciprocal tariffs, but not much else. Red, you're the enemy. You're not helping us at all. You're an adversary. You're going to get punitive tariffs, and forget reciprocity. You're just going to get punitive tariffs, no help in anything else. And probably, at least for now, China and Russia would be in that category. And now this is where it gets back to Zoltan. It gets really interesting. The other thing he wants to do is swap Treasury bills for 100-year debt. They call them century bonds. These are U.S. Treasury bonds with a 100-year maturity. And they're a little sketchy, but I think they want to do original issue discount, meaning there's no coupon. You basically pay $40 for a $100 bond, and then 100 years from now, you get your $100. So you make money. There is interest, but it comes in the form of what's called original issue discount. You just buy it for less, and then it accrues up to the level of maturity. What's the nice thing about that? No checks. You don't have to send any coupons out. So you improve your cash flow. And accountants would say you got to record the interest, yeah. But the United States government is kind of on a cash basis entity. There's no checks, no negative cash flow. We'll all be dead in 100 years. And
That's
so
true. Yeah.
see you in the 22nd century. And that also solves the fact that, Treasury bills, they're 30 days, 60 days, 6 months, up to 1 year. You got to roll them over all the time. You're always in the Treasury market issuing those bills. So what we have is this combination: tariffs, yes. Hey, trading partners, don't you dare cheapen your currency. We're going to cheapen the dollar. If you're not working with us on that, we're going to use coercion. We're going to use this traffic light system I described. We'll have, anyone who's in the green category, you're our friend, so you're going to get a little bit slightly better treatment on tariffs. And by the way, we're going to, he kind of suggested they would force it, which is really weird. This is like a default. But we're going to force people to hand in the Treasury bills and take 100-year notes in exchange and see in 100 years. Interesting. Oh, so one more aspect of it. Just have the Treasury pick up the phone, call the Fed, and tell them to revalue the gold certificate from $42 an ounce to, I think this morning was $3,149 an ounce. And that would put $800 billion of cash in the Treasury general account without issuing new debt. And all the gold bugs are like, oh, you're going to raise the price of gold. No, you're not. The price of gold is the price of gold. It's $31.50 today. But it would just be an accounting entry on the books of the Fed, but it would add $800 billion of cash to the Treasury account with no new debt. That part is true. Gold is a world price, world market. It wouldn't affect the price of gold. And it's not a gold standard. It's just an accounting entry. But, I'll take $800 billion of, walking around money, as we say in Philadelphia. So that's the Miran plan. So you've got Bessent's 3 arrows, Navarro's tariffs, and Stephen Moran's Mar-a-Lago Accord. We'd have to sit down at Mar-a-Lago and agree on everything, and we'd have friends and some enemies. So that's what they're doing. I say one last thing is Bessent wants to, he said, he wants to monetize the asset side of the U.S. balance sheet. As people are so focused on the liability, that's the 37 trillion dollars of debt. Yeah, that's a big deal. But what about the assets? And when you say this, the political enemies say, "Oh, what are you going to do? Sell the Grand Canyon? Sell Yosemite Park?" No, they're not going to sell the Grand Canyon. But if you look at a map of federal lands, like almost everything west of the Mississippi and a lot east of the Mississippi is owned by the federal government. What's on it? Gold, uranium, lithium, strategic metals, etc., oil, natural gas. A lot of it was taken off limits by Biden. They just started declaring desert, whatever, federal wilderness area you can't drill. We can change that, and then start. You can do leasing, giving oil companies or energy companies exploration rights, take royalties. There are a lot of ways to monetize that, gold mining, et cetera. Get rid of regulation, make more land available, and take leases and royalties. And then that's a lot of balance. That's what Bessent means. So that's the big picture. A lot of moving parts, but they're all working together.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. I love it. And Jim, I always say this to you. I love just listening to you and letting you just go uninterrupted, because you bring a wealth of knowledge, and I know the audience enjoys it as well. So on that last point, when you're talking about this opportunity of look at all the federal lands we have, and maybe you could lease it, you point out there's gold there. Does that kind of tie back to, there's this, as you kind of have put it, a myth that the US could go bankrupt? It sounds like we have a lot of options and a lot of wealth that has not been tapped into. Is that fair to say?
It's absolutely fair, and it's exactly correct. We're not going to go bankrupt. I mean, at the most basic level, I'm not saying every outcome is good, but bankruptcy is not on the table. For the simple reason that our debt is denominated in a currency that we print. So in distress, people say, well, gee, what if China doesn't buy treasury notes? What if, Russia, well, they don't buy them anyway. We froze theirs. We're in the process of stealing them. But what if the world wakes up and decides they don't want any more treasury bills? You just call Jamie Dimon and say, Jamie, shoot him in. Just, but we control you. We regulate you. We can help or destroy your destiny. So start buying more treasury securities. And they will. And I'm picking on JP Morgan, but JP Morgan, Citi, Goldman, Morgan Stanley, Wells Fargo, Bank of America, all the too big to fail banks, they would have to buy more treasury. And the Fed could always buy more treasuries. And if JP Morgan needs money to buy the treasuries, they got I don't know how many $100 billion are in reserves at the Fed. So there's plenty of money to go around and plenty of institutions to buy. So we're never going to have a situation where nobody buys treasury securities, because if that situation even emerged, as I say, the banks and the Fed would pick up the slack. It's not likely to happen anyway. I mean, that's what I described as the default position, but I don't mean financial default. I mean, just kind of plan B. But the world wants treasuries. That's the thing that nobody understands, or not, I shouldn't say nobody, but a lot of the bankruptcy critics don't understand. The biggest problem in the world today financially is not that people don't want treasury securities. It's the opposite. There's a dollar shortage. There's a global dollar shortage. And people go, wait a second, the Fed printed $10 trillion. How could there be a dollar shortage? That money didn't go anywhere. The Fed prints it by buying securities from the big banks, Goldman, Citi, the ones I mentioned. And the way they do it, they just, open market desk calls up Goldman Sachs trading desk and says, offer me 10-year notes or 5-year notes, whatever, and Goldman makes a price, done. And Goldman sends the notes to the Fed, and then the Fed pays for it with money that comes out of thin air. That's true. And that is money printing, if you want to call it that. But what does Goldman do with the money? They give it back to the Fed in the form of excess reserves. So all you're doing is inflating both sides of the Fed balance sheet. But that money, it's not going to business. It's not creating jobs. It's not being lent to entrepreneurs. It's not helping consumption. It's not doing anything. It's just sterilized on the Fed's balance sheet. The money that does drive the economy is created by banks, not the Fed, but commercial banks. If they make you a loan or make me a loan or whatever, we can, put it to good use. That's the problem, that there's not enough of that kind of M1, M2 style money creation. But people look at the Treasury publishes, I think it's monthly or quarterly, I think it's monthly, a report of foreign holdings of U.S. Treasury securities by country. So China, Saudi Arabia, India, and so forth. And people see China going down. The Chinese ownership of Treasury securities is going down. And it has been. You go, see, the Chinese are dumping Treasury securities. No, they're not. They wish they had more. They are selling them because they need cash to prop up their banks. And that's the dollar shortage. And that's going on around the world. That's extremely dangerous because it threatens liquidity. And, you're very nice to say that, like you let me roll the listeners kind of enjoy the commentary, but here's something they may not enjoy, or at least, but they should know. There's a huge time bomb inside that Mar-a-Lago Accord, which there are only a handful of people who understand it, and primary dealers understand it. A few experts understand it, but apparently no one in the White House does. If you Treasury bills are the red blood cells of the global monetary system. Red blood cells carry oxygen and they keep you alive. Treasury bills carry liquidity. They keep the system alive. We have $1 quadrillion. That's 1,000 trillion notional value of derivatives off balance sheet all over the world. So when you think about every swap, future, option, swaption, and caps, floors, on and on, that notional value adds up to $1 quadrillion. How does that market work? It's all leverage. UBS does a $10 billion swap with Citibank, and fixed versus floating, and the economics of it. You can make or lose money. You're hedging. Same thing in the euro-dollar market, goes on all the time. But what if you make a lot of money and the counterparty defaults? How do you? By the way, I lived through this. I did the LTCM bailout, so I kind of saw it in real time. If the counterparty defaults, then your profit goes away. Like, you made all this money. And by the way, chances are you're in a hedge position. So you're making money on one side, but you're losing money on the other side. So bankers really work on the net. They're trying to make a net profit. Well, if the losing side is one that you have to pay and the winning side turns into a losing side because the other guy went bankrupt, you're out of business. And that's contagion. That's how it spreads. How do you protect yourself against that? Collateral. What's the best form of collateral in the world? Treasury bills. They're guaranteed. They're not 100%, but basically they're the safest, most liquid, least volatile security in the world. And that is the basis of collateral in all these markets that we just talked about. Don't send me your mortgages. Don't send me even 10-year Treasury notes are a little flaky for this purpose. Off the runs, no interest. Send me Treasury bills, 4-week bills, 3-month bills, 6-month bills, etc. If you if you make everyone redeem their bills for 100-year bonds, where's the collateral? You could have triggered the greatest liquidity crisis in history and collapsed the entire monetary system. And I don't think Miran knows that. Hopefully he's listening to your broadcast so we can pick up on it. But and I'll be talking about it and writing about it some more. But that's the Achilles heel in the Mar-a-Lago Accord, which is, if you're going to issue 100-year bonds, because there is a debt ceiling, if you're going to issue all these so-called century bonds and drop the bill market, you're going to collapse the derivatives market.
So do you need the shorter dated Treasury bills?
Well, a century bonds are 100-year bonds.
Right, right.
What you need are lots of bills. Just keep issuing bills.
I have a question for you. Wasn't one of the issues like when Yellen was at Treasury that we issued at the short end? Like,
yes, exactly. You're exactly
so how
right.
do you balance it? Like, what is the move?
Keep issuing bills. I mean,
Okay.
Janet Yellen didn't really understand what we're talking about right now. She's not that good of it. She's kind of a statistics geek. She didn't really understand what we're talking about, but somebody got through to her. And I don't know whether it's the Treasury Borrowing Committee. I don't know. Maybe Jamie Dimon picked up the phone. I don't know how the message got through, but the message did get through. And all of a sudden she's issuing, hundreds of billions of dollars of Treasury bills, and it worked. And the market remains liquid. People like Treasury bills for the reasons I mentioned. So if you're just looking at the liability side of your balance sheet, you're like, well, why wouldn't you rather have 100-year debt than 100-day debt? Well, you probably would, except that 100-day debt or a 3-month bill in this example is what keeps the entire global monetary system up and running. And so I don't think they really understand the impact it would have on collateral markets, derivatives markets, and bank balance sheets.
Interesting. I want to go back to another point you made about it's like an intentional weakening of the US dollar. Could you explain that a bit more and what the implications there might be?
Well, it is, it's somewhat inflationary in the sense if you weaken the dollar, then Americans have to pay more for foreign goods. So if you're buying a Swiss watch, French wine, Japanese manufactured goods, vacation, whatever, in a world of weaker dollars, you're going to have to spend more to get those foreign goods and services. That may actually help the trade deficit because if Americans say, well, I can't afford a European vacation this year because the dollar's cheap, I'll go to the Grand Canyon or Disney World or something like that. That at the margin that could help with the trade deficit, which the Trump administration is very focused on. But what it really is, it's not so much that they want to. It also makes U.S. goods less expensive from the foreign point of view. Just as it makes foreign goods more expensive for U.S. consumers, it makes U.S. goods less expensive for foreign buyers. So if you have Europeans or Chinese or Japanese or anybody else, and you need U.S. inputs, I mean, think about a world where we're manufacturing more in the U.S. and foreign trade partners want to buy our stuff, which is what we hope for, and you weaken the dollar, they can afford more stuff. It makes U.S. goods more affordable. And it's also a warning shot to the trading partners. Don't you dare cheapen your currency to offset the tariffs. We're going to cheapen our currency because we want to sell more exports. The trade deficit, of course, has two sides, imports and exports. Well, the tariffs are a way to reduce imports, but the cheapening the currency is a way to increase exports. And the combination will reduce the trade deficit and help GDP. I mean, this is all, it's a very complex, certainly complicated machine with a lot of moving parts, but this would be, cheapening the US dollar would be one of those parts. And it is what, as I said, Nixon and Baker did it in the 70s and the 80s. But we're not living in that world. It's a different world. It's more, whatever you think of globalization, the nationalists and, the Trump team, the MAGA team don't want globalization. Okay. But it's here. I mean, you can try to reduce it or back away from it a little bit, but it's here. My book Sold Out was on the supply chain. These supply chains are real. They did break down in beginning of 2018 through 2020. Of course, COVID made it worse. It did contribute to the extreme inflation we saw in 2022. June 2022, inflation was 9.1% annualized. So it has all those impacts. But Miran wants to cheapen the dollar to promote exports, which it does. If you're Indonesia and you're shopping for an aircraft and your choices are Airbus or Boeing and the dollar is weaker, you might buy Boeing. And so obviously that helps our manufacturing jobs in the U.S. and trade, reduces the trade deficit, increases exports, all the things we've been talking about. But what Miran's also talking about is threatening our trading partners. don't you dare try to cheapen your currency. And but he will not have the cooperation that James Baker had. What he wants to do is use coercion, and including the traffic light system I described. So that's the point of it.
Mm-hmm. Let me ask you this, Jim. Do you think, are we making the right moves here?
Yes and no. I think tariffs I'm all for tariffs against the American way, the American system. I think that's a very good move. Scott Bessent's 3-3-3 plan makes perfect sense. It's, like I said, it's simple math, but yeah, you don't have to wipe out the debt. All you have to do is reduce that ratio, debt to GDP ratio, get moving in the right direction. That would be extremely beneficial. And then, the oil production will, basically be if not deflationary, at least disinflationary. It'll fight the inflation we've all been living through. So Bessent's 3 hours plan makes perfect sense. Navarro's tariff plan makes perfect sense in my view. Create high-paying jobs. Those are good things. Miran's Mar-a-Lago Accord, I think it has some major problems. The first one being, it's not relying on cooperation, it's relying on coercion, which could have boomerang effects. And I think he completely misses the importance of Treasury Bills to the banking, to the Eurodollar system and the derivatives markets. So that's the one that I would be most concerned about. And I don't think, and I talk to some Trump people from time to time, I don't think that analysis that we've just gone through has really sunk in at the White House. Hopefully it will.
As we were recording this, or you mentioned the price of gold. It is a topic that's quite popular on this show. And looking at it right now, 3,124 for an ounce of gold. What's been kind of driving gold's movement, or are there signals that you are getting from gold when you look at that market? What is it kind of signaling to you?
Sure. The drivers, there are several, which is a good thing if you want gold to go up. I like it.
A lot of people who watch this channel like it too.
Yeah. Good. We're all on the same page. Okay, so the first one is central bank buying. By the way, there's almost no retail interest in the United States. There is in other places, India, China, not in the U.S. So I run into people all the time, and they say, "Yeah, Jim, I talked to you a year ago, and then you said buy gold." And I said, "Yeah, did you?" And they go, "No," because the retail. There is no retail frenzy at all, and there's barely any retail notice. A few people are buying the GLD ETFs a little bit, but the buying is coming from institutions, in particular central banks. So we know who they are: China, Russia, India. Actually, Vietnam is a big buyer. Mexico, Kazakhstan, Philippines. You look around, and all this data is available. You just go to the World Gold Council website. You have to give me your email address, but it is free, and they have a really good database, so you can find it very easily. And they also break it down. Oh, so Turkey's another one. Iran's non-transparent, but they're buyers. So they're all buying gold as a hedge against inflation, hedge against dollar devaluation, and some of the problems we've been talking about. But the biggest hedge is that the U.S. At the beginning of the war in Ukraine froze approximately $300 billion of Russian-owned Treasury securities. Now, Russia made the money legitimately selling oil. They got paid in dollars. They took the money. They trusted us. They bought Treasury securities, all different maturities, probably a lot of bills, but also intermediate-term Treasury notes. And they had, trying to get the exact number, probably over 50% of their reserves in U.S. Treasury securities. But they were, because the U.S. dollar denominated, they were held mostly in a custodian in Europe called Euroclear. It's in Brussels. So Euroclear has $40 trillion of assets under custody. It's one of the largest custodians in the world. So we and the Europeans froze those assets, which is easy to do, because the Treasury and the Fed control the ledger. They're all digital. The last paper Treasury security was issued, I think, in 1978 or 79. So maybe someone's got one in their grandmother's attic, but they've been digital for decades. So they were frozen. But we're good at that. We freeze it all the time. The idea that the U.S. doesn't do it, we do it all the time. But what was different is we went a step further with Russia. We didn't just freeze them. We started to seize them. steal them, convert them to our use and NATO, and they were collateral for a $50 billion loan to Ukraine. So think of the irony. Russia makes money selling oil. They put the money in treasuries. We steal the treasuries, use it to borrow money, and give it to Ukraine to fight the war against Russia. So that's what's going on. Well, India, China, Saudi Arabia, even Japan, Taiwan, others, and some of these people have upwards of $1 trillion, not quite $1 trillion, but upwards of $1 trillion of treasury securities. Taiwan certainly does. They're looking at this and saying, wait a second, what if the U.S. wakes up and decides they don't like what I'm doing, or they don't like my policy? Are they going to do this to me? Well, how do you know? Well, one way to protect against that is physical gold. It's not digital. You can't freeze it. You can't seize it. Assuming you repatriate to your own country, put it in a nice vault, have an army, no one's going to touch it. By the way, Russia did that. In addition to, I mentioned $300 billion in treasury securities, but they had $150 billion at the time of gold, physical gold. And I always say Elvira Nabiullina, she's the head of the Central Bank of Russia. I would say she's the only central banker in the world who actually understands her job. But they put so much of their reserves in gold that has preserved them and helped them get through the seizure of the U.S. Treasury securities and actually keep the Russian economy going and keep fighting the war in Ukraine. And I teach a class in financial warfare at the U.S. Army War College, and I try explaining this to the kind of mid-level career officers, lieutenant colonels, and some full colonels, and Navy commanders and others. I say, not only did they preserve those assets, $150 billion worth of gold at the time, against seizure by the United States, but the fear created by the sanctions and the kinds of things we've been talking about has caused the price of gold to go up. But again, going back to your question, which is why is gold going up? Russia has made, last time I did the math, it was 50 billion, but I imagine today it's closer to 70 billion. Russia has made $70 billion in mark-to-market profits on their gold. So, okay, we seized 300 billion, but they made 70 billion over here on the gold. So it was a very smart move by Nabiullina. But others are making a lot of money too. So first thing, sovereign wealth funds, but really central banks are buying gold. Look at the output side. Global gold production, total mining production has been flat for 6 years. I'm not saying peak gold. I'm not saying there's no more gold in the world. It's not going down, but it's just flat. So if you have, this is like first week in the economics class, right? Increasing demand and flat supply, what happens to the price? It goes up.
Yep.
So that's an easy one. There's people say gold's an inflation hedge. That's debatable. I mean, it did go up in the 70s, but it's not as highly correlated as most people think. But gold is what I call the everything hedge. It hedges geopolitical uncertainty, wars, seizures, inflation, economic collapse, market collapse, every bad thing you can think of. Gold gets you through it. It usually does pretty well in all those scenarios. So you got central bank buying, flat output. It's the everything hedge, the uncertainty hedge, et cetera. And so those are fundamental drivers of the price of gold. But the other thing, this is kind of a psychological thing, and you know this, when you have $100 increase in the price of gold. I mean, last week it was like 30. I went to bed and I woke up and it was like, I looked at the ticker, it was like 30.25. So I went down a little. I said, oh no, that's 31.25. It went up almost $100 overnight. Now, just to take $100 increments, okay, so 3,100, 3,200, 3,300. So that's the path it's on. Holders, investors think, oh, I just made $100 an ounce, or 10 times I made $1,000 an ounce, et cetera. So they tend to think in terms of those fixed dollar mark-to-market profits. But every increase is easier than the one before because you're working off a higher denominator. Again, coming back to the ratio. So if you go from $2,000 to $3,000, which we just did, that's a 50% increase. But if you go from $3,000 to $4,000, that's only a 33% increase. And if you go from $5,000 to $6,000, that's only a 20% increase. Now, it's still $1,000. You made $1,000 an ounce. Nice going. And that's how people think about it. but they lose sight of the fact that every jump is easier than the one before.
Interesting.
So by the time you get to $9,000, what does it take to get to 10? That's only an 11% increase. That's like a good week. So that's when you get into the frenzy stage. So I run into people all the time. I mean, I was talking to people last week. They said, Jimmy, I missed the boat on this. I should have bought it when it was 1,800. Said, you have not missed anything. This party is just getting started. And if you don't have any gold, buy it now, because we got a long way to run.
Interesting. And I have to say real quick, Jim, I lied on the price of gold because I relied on the Google's widget. It's $31.55. I'm sorry, y'all. I was off by like $24. Google's off, but it's up $40 today.
Yeah. So, I use the COMEX.
Yeah.
COMEX futures spot price or spot contract, near contract. That's kind of the most liquid market. But yeah, there are a lot of indices out there.
Do you have
31.50? All right.
Yeah. Do you have time for one more question? Okay. The last time I had you on would have been right after the election, and we were just kind of thinking about, the Trump 2.0 administration and what that would mean for the economy and the markets. And if I recall correctly from that conversation, you mentioned that we'll need to do some short-term pain early on in the administration to set us up for that longer-term gain. And it'll be maybe a little painful to start. And then if they're successful, it'll be great, like 2 to 4 years out. Do you still kind of hold that thesis, or what is kind of more of your view or outlook, if you will?
Well, I do. But by the way, thanks for bringing that up, Julia. That played out. I said that in November, and the stock market's is down almost 20%. It blew past 10%. I think it's down around 15, 16%, but it's getting close to a full 20% bear market at this stage. So that it played out as I described it. Now, one thing that Trump did really well is because he was during the campaign and a little bit in the beginning of the transition after the election, he was taking credit for the stock market, because the downturn really started in December. I forecasted in November. In November, the stock market was still going up, and then December was the big turn down. But Trump was like, "See, I got elected. The stock market's going up," and I told some Trump advisors, I said, do not marry the stock market. I said, the stock market goes its own way for its own reasons. It's very volatile, very unpredictable. It's a lot of emotion. And if you take credit for the stock market going up, you're going to get the blame for the stock market going down. And I think it is going to go down. So you don't want to kind of hitch your wagon to that particular start. And Trump got that message. Because he said in a number of interviews, well, if stock market's going down, it's kind of like too bad. I'm focused on the big picture. I'm focused on long-term growth. I'm not focused on the day-to-day movements of the stock market. So he did a good job of separating himself, and it is going down now. Nobody thinks that's wonderful, but it is, that's really part of a normal cyclical recession that we're probably heading into. A lot of it's the Biden hangover from withdrawing fiscal policy, from all these checks that they were handing out during COVID. Trying to reduce the budget deficits. And so there will be that kind of pain, and it will be reflected in the stock market. And I think Trump did a good job of distancing himself from the ticker, because we'd really be working against him right now. It's going to get worse. It's how much worse remains to be seen. I'm not predicting, I don't do end of the world stuff. And I don't want to say how much it could go down, although 30 to 50% would not be, highly unusual. Doesn't maybe every 10 years or so it actually does that. But let's see what happens. But we're probably going, at best case, we're going into a recession. The stock market's going to go down more. Unemployment's going to go up. The Fed, of course, will be the last to know. They're going to sit there and pause on interest rates and not cut. They should be cutting now. They're not. But cutting actually doesn't do that much. People think low interest rates are stimulus. They're not. I mean, low interest rates are associated with recessions and depressions. In a booming economy, interest rates should be 6-7%, but that would be a good thing, because it means borrowers who pay 6% think they can make 12 or 15 or more. So higher rates are actually a sign of a robust economy where there's a lot of demand for borrowing and money creation at the bank level and investment. So, but 1% interest rates or zero, thank you, Bernanke, that's a sign of recession or depression. So there's no stimulus effect, but the Fed will cut interest rates anyway because unemployment's going up. and the stock market's going down. By the way, the people talk about the Powell put. This goes back to the Greenspan put, the Fed put, the Powell put, the Yellen put. The idea basically is don't worry about the stock market, buy the dip because the Fed will bail you out. It's not true. The Fed kind of doesn't care about the stock market either. The only time the Fed gets involved is if it becomes what they call disorderly. That's one of those buzzwords, but it's the word they use. So a long, slow grind down of the kind we saw from 1969 to 1982 is not the Fed's business. A crash, the kind of thing you saw on October 19th, 1987, when it fell 20% in one day. That is, I mean, that there is, if not a put, the Fed will intervene in those situations, but those are extreme situations. So if it becomes disorderly, the Fed will do something. But if it's just grinding down, no, there is no Powell put.
Jim, I have to say, we always love having you on. Before I let you go, do you want to leave this audience with some parting words? Let them know where they can find you, support your work, subscribe to your work, buy your books. Anything that you'd like to leave this audience to think about, or again, let them know how they can support your work. The floor is all yours.
Yeah, thank you. I have a Twitter account. It's at Real Jim Rickards. At Real Jim Rickards. That's my Twitter account. I put out basically a lot, commentary and interviews and links and so forth. I've written 9 books, but the one that's out now, relatively new, is called Money GPT. Money GPT. It's about artificial intelligence and the impact on the financial markets. It's not a stock tip book. I'm not going to tell you whether you should buy NVIDIA or not. But I'm talking about and AI is a big deal, that's there, but I'm talking about the dangers of AI in financial markets. We're substituting artificial intelligence for human judgment. And the problem is all these AI algorithms are the same. I mean, I don't care, there are 10,000 registered investment advisors. They're all looking at the same screens in effect. And so are the professional traders. So you get into a kind of a doom loop there possibility. And then I talk about the impact on the banking systems. That's Money GPT. You can get it on Amazon. And my flagship newsletter is Strategic Intelligence, Paradigm Press. So if you just Google Strategic Intelligence, Paradigm Press, will find us.
Jim Rickards, thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas, and just for helping us learn. We love having you on. We love listening to you. So thank you again. Really appreciate you, and have a wonderful rest of your day and week. And until next time, be well, Jim.
Thanks.